Hello, my name is Lachlan St. Clair and I'm the principal here at CSP. And today I'd like to take you through the first of a series of 3 videos about how we manage money, and in particular pension money, for people who have moved into retirement with their superannuation savings. Part 1 of this video, we concentrate on something that we call the conundrum. And it's an issue that we think most people who walk through our door face. Either they understand it or they don't, but it does lead to a freeze in the investment decision-making process. And I suppose at CSP here, we're experts at trying to unravel that conundrum and show people how to build an investment strategy. So let's take you through the first section. Just unfortunately some maths to start off with, but when you get to age 65, most people generally take around about 5% of their superannuation balance as an income stream. So if you've got $1 million in superannuation, you might start with a figure of around about $50,000 a year in terms of income. Now, if you're drawing 5% out of that superannuation balance, and let's say inflation is running at 2%, it's not rocket science that you need a return of around about 7% or so in order for your investment over time to replace the money that you're drawing out of it, so that it'll last you for a long period of time. The problem that we have at the moment is that you can't get a return even close to 7% if you sit in things like term deposits and cash. You know, if you're doing well with a term deposit at the moment, you might be getting 2.5, 2.6% if you're lucky, but you're absolutely nowhere near the 7% figure that you need in order to set your superannuation up so that it's going to be sustainable over the long term. And what this means is that you need to introduce other assets into your superannuation in order to boost the return. And in particular, you usually need a fairly reasonable component of shares. Now, the problem with shares, of course, is that they can be volatile and they can really move around a significant amount. You know, share portfolio can lose 50% of value. You know, we lost 50% during the GFC. We lost 50% during the 1987 crash. We lost 40% in the 1980s, early 1980s, and we lost another 50% in the 1970s. So losing 50% in the short term in the equity market is not an unusual thing. And so the problem that you get is for when you moved into retirement and you have this perception that this is all I've got and I can't afford to lose any money, that it's very hard to take the risk with that part of the portfolio. So, you know, although you know you need the return, you can't afford to take the risk. And that's the conundrum that we're talking about. You know, how do we get a return of 7% without taking risk, or with managing the risk, I suppose, is more the issue. So join us for part 2 of our video series, where we introduce a new way of thinking about your superannuation and then show you how CSP's investment program solves this conundrum for you. We'll see you soon. Hello, welcome to our second video in our 3-part series where we talk about CSP's retirement strategy and how we build investment strategies for people's superannuation to see them through their retirement. In our first video, we spoke about the conundrum that a lot of people face when they move into retirement, and that is, what do they do with their superannuation? How do you invest your superannuation in such a way that you can get a reasonable return? You sort of need 5, 6, 7% or so in order for your money to last you a long time, but not expose that portfolio to any risk. If a share market crash happens and your money's in the share market, you don't have any more time left. You can't recover. And that's the conundrum a lot of our clients face. The secret to unlocking this conundrum is you need to change the way in which you think about your superannuation. If you think about your superannuation, let's just say you've got $1 million of superannuation and you want to draw a $50,000 a year income stream. If you think about it as one homogenous pot of $1 million, I should say, you can't unlock the conundrum, because you can't afford to take the risk with the $1 million, but you need to invest the $1 million because you need the return. It can't be unlocked. The trick to unlocking it is not to think about it as a pot of $1 million, is to think about it as a series of $50,000 income payments. It's $50,000 this year, $50,000 the next year, $50,000 the year after retirement. And when you do this, you can now start to unwind the conundrum, because the $50,000 lump of money that you need next year to live on, for your living expenses, you clearly can't afford to put that in the share market. If it share market crashes, there's no guarantee at all that it's going to have recovered within 12 months. So you need to have that $50,000 stashed away in something really low risk, low return. But the $50,000 lump that you don't need for 15 or 20 years, that is a long time for equity markets to recover. I would suggest that you can definitely afford to take risk with that part of the portfolio that's funding the really long-term assets. So if you break into a series of income payments, the short-term stuff we can't afford to take risk with, but the long-term stuff we definitely can. What we're really doing here is we're breaking the money into a series of payments, and then we're just aligning when we need that pot of money with the risk that we're exposing that pot of money to. That's really all we're doing. But if you think about it as a series of payments, it becomes much easier to do. Now, at CSP, we refer to this as our bucket strategy, and we have 3 buckets within our portfolios. The first bucket, bucket 1, is your low risk, low return bucket. This includes things like term deposits, cash, very short dated bonds, so things that really aren't very particularly volatile. Unfortunately, they don't give you very much return, but they are very, very, very secure. Now, back on our example, if we've got $1 million and we want somebody wants $50,000 a year of income out of that, we might put, for the sake of illustration, say 4 years worth of income into bucket 1. So 4 years of $50,000 is $200,000. So $200,000 gets stashed away in very low risk, unfortunately low return, but low risk type assets, because that's our short-term money needs. Now, some clients have more than 4 years, some have less than 2 years. Don't worry for the moment about the size of the bucket. It's the principal at this stage that matters. So your short-term money is locked away. You then have what we call bucket 2, which are our alternative assets. And bucket 2 has generally another 4 years worth of income in it again. These are investments where we can afford to take a little bit more risk because we don't need them for the medium term, and we're hopeful of getting more return than we are of cash, although certainly not pushing it as far as shares. For us, this includes things like infrastructure, some certain types of hedge funds, managed futures type funds. They're a little bit more complicated, this one, so we can talk you through when you come to see us. But just for the purpose of this, they're alternative assets, a little bit more return and a little bit more risk than cash, but definitely less than shares. And as we said, average client might have another 4 years worth of income, so 4 years in bucket 1 and 4 years in bucket 2, gives us to 8 years worth of income in total. We've then got bucket 3, which is the remainder. $1 million, we've got 4 years or $200,000 in bucket 1, we've done another $200,000 in bucket 2, that leaves $600,000 that we can put into bucket 3, which is essentially our shares bucket. Yeah? Bearing in mind, we don't need that money for 8 years from when we first start off the program. As I said, some clients want more, some want less. We can tailor the size of the buckets and talk you through the consequences of that when you come and see us. But the principle here is the really important thing that matters. So the really critical question is 8 years enough time for the share market to recover? It's a really important question. And we can actually, if we go to a graph of the share market, we can actually see that, yes, it actually is quite a reasonable period of time. What we've got here is our share market graph from video 1 that shows the equity market volatility in the major falls. However, what we want to look at this time is, instead of how far it falls, we want to look at how long it takes to recover. And you can see from this graph, where we've overlaid the red line, that there's really only been, since 1980, 2 material periods of time where it's taken sort of more than 2 or 3 years for the market to recover. And that was right at the peak of the 87 crash and the GFC that's just gone past us. So you can see the GFC was the longest it's ever taken to recover a previous high. It took 6 years. If you invested the day before the crash in 1987, it took you 5 3/4 years. Everything else, it took 2 2/3 of a year in the early 80s with the major recession we had, and everything else on this graph is less than 2 years, and that's 36, 37 years worth of data. So nothing's guaranteed in the investment world, as I'm sure all of you know, but I think if you set yourself up with your portfolio with 8 years of protection, it's got to be 33% worse than it's been ever since 1980 in order for you to get caught in a negative position. So as I said, nothing's guaranteed, but I think this is a pretty reasonable basis to make an investment decision. So, just in summary, the trick to solving the conundrum is not to look at your superannuation as one big homogenous pot of capital. It's to look at it as a series of $50,000, series of income payments, and then all you're really doing is matching when you need those income payments with the risk you're exposing those income payments to. So, join us for our third video, where we take this discussion out of the hypothetical and show you how we actually do it at CSP and what our actual processes look like. We'll see you soon. In this video, video 3, what we want to take you through is our CSP dashboard. This is the document that we use for all of our review meetings with our clients, and it allows us to very quickly get a feel for exactly what the investment market's doing, what clients can expect in terms of a return profile on their superannuation going forward, and most importantly, how long they can expect that superannuation to last. So let's take you through the document now. So what you can now see in front of you on the screen is a cut down version of CSP's dashboard. First of all, we've got an annual pension amount, which in this case is $80,000. So this particular client's drawing $80,000, and $80,000 as a percentage of the $2 million they have in capital is 4%. That's where that 4% figure comes from in there. And this client has a balanced risk profile. We then move down into an allocation by buckets. So for those of you who've seen the previous video, we know that we allocate the money across 3 separate buckets. In this particular client's case, they've got $400,000 in bucket 1 investments, and that gives an income coverage of 5 times, which is simply $400,000 divided by $80,000 worth of income. So if something goes horribly wrong and the markets all fall away, this client's got the next 5 years worth of income locked away in low risk, low return assets. There's then another $400,000 in bucket 2 assets, which is another 5 years worth of income. And finally, the remainder, which is $1.2 million or 15 years worth of income, is sitting in bucket 3 assets, which are generally equities and shares, both international and domestic. So nothing particularly revelatory just far. It's just giving you a snapshot view of where your risk sits and your allocation across the buckets. We then drop down to the second section here, and I'm not going to spend too much time on this portion of this table, but this is a traditional asset allocation, and really all it's giving you is, for all the investments that you have, when you break it into the exposure you have by asset class, so cash and Australian shares and international shares, etc., how much your exposure is across those various assets. And in this particular client's case, you can see we've got 24% in defensive assets, we've got 68% in growth assets, and we've got a little bit in alternatives. Where I really wanted to focus was on the next section. So you can see here to the right of the asset allocation, we've got a 10-year forecast return. And these are, we buy this information in, this research in, so it's not information that we generate internally here at CSP. And what this tells us, or what it gives us, is the forecast of each of those asset classes and the expected return or the return they're expected to make per annum over the course of the next decade. So in this particular case, for example, for Australian equities, when we put this together, the expected return was 7.6%. International equities were 5.7%, etc., etc. Now, where this becomes particularly valuable is that if we know how much we've got in each asset class, and we know how much we expect that asset class to earn over the next decade, then we can do some mathematics and we can generate a 10-year forecast return off that number, which in this particular case is 5.4%. Now, for those of you who are going to try to reconstruct this at home, that 5.4% is the gross return, less fees and less tax, depending on the taxation structure that the client's sitting in. So we're expecting this portfolio to do 5.4% per annum for the next 10 years. We expect inflation at 2.3%, and therefore the real return, or the return above inflation, we expect on average to be 3.1%. And basically what this then says is, if you draw a income of $80,000 from a pool of $2 million, and you generate a return on average of 5.4%, and inflation's running at 2.3%, then we would expect that portfolio to last you 50 years. Now, when I talk about that portfolio lasting you 50 years, if I talk to you mathematically, because I'm using an average return, what I'm really saying is that is a number in which I have 50% confidence. When I talk to you more accurately, I am 50% confident the portfolio will get at least 5.4%, and therefore I am 50% confident that the portfolio will last you for 50 years. Now, when you think about it, that's not a particularly useful piece of information at the end of the day. To give you information in which I have 50% confidence, I don't think is a particularly strong foundation for decision making. So what we can do is, if we take 2% off that return, 5.4, we bring it down to 3.4, that converts to an approximate increase in confidence up to 80%. So what I'm saying is, although I'm 50% confident we're going to get a return of at least 5.4, I'm actually 80% confident that I'm going to get a return of at least 3.4. And at a 3.4% return running through the same mathematics, we would expect this portfolio to last you for 30 years. So I'm 50% confident it's going to last for 50 years. I'm 80% confident you're going to get at least 30 years out of it. And I think that 80% confident is a much better foundation for decision-making processes for clients. So this is the basic of how the dashboard works. And this 80% confidence figure is really the key one on this dashboard that we encourage our clients to focus upon. Now, that's all well and good, but let's have a look at an example of some of the decision making that this dashboard allows. So a client might come in the door and say, look, that's well and good, but 80 grand's not enough. I'd really like to live on a little bit more. If I increase that from $80,000 to $100,000 per annum, how long is the portfolio going to last me? So we can just update the numbers. And if we put $100,000 into the mathematics, roll through, we go from 30 years down to 23 years. Now, if you're 50 years of age or 55 years of age, that's probably getting cut it a bit short. But if you're in your late 60s, early 70s, these sort of numbers are starting to make a little bit of sense. So again, we can help clients come up with income figures that suit what their requirements are and match back to their life expectancy, what their needs and requirements are. So you can see how we can use this to model different levels of income and give our clients a good understanding of what the consequence is going to be in terms of how long that portfolio is going to last at a reasonably high degree of confidence. Where we can also use this model, and this is particularly powerful, particularly given the current economic environment, is to ask the question, is now the right time to be investing in shares or to have a fairly high share exposure? And I suppose the reason we put that on the table is a couple of reasons. Firstly, the economic environment at the moment is not looking all that positive. Things are looking like a downturn. Secondly, there has been a good equity market run for the last 10 years or so. And thirdly, and most importantly, you can see here that the returns on the equities on domestic, not too bad at 7.6, but certainly international and the emerging markets at 5.7, are not really a huge amount higher than the returns you get in the B1 and the low risk type assets. So the question to ask is now the right time to be worth taking the risk? Now, the way we help clients answer that question is not to talk about impact on expected 10-year numbers or return numbers. The real question is, okay, well, if I de-risk the portfolio, what's the consequence on longevity? So in this particular case, this client's got 1.2 million. Let's say we wanted to model what would happen if we took a third of their equity exposure out and put it into conservative assets. So a third of 1.2 million is $400,000. So when I press enter, the B1 assets are going to go from 400 to 800, and the B3 assets are going to go from 1.2 million to 800. So taking 400 off one and put 400 on the other. Now, quite clearly, the number to watch is down here. What happens to the portfolio longevity at 80% confidence if we take 1/3 of the equity market risk out and put it into B1 style assets? $400,000, we've got 23 years at the moment. We de-risk and we're still at 20 years. Now, 23 years down to 20 years is not a particularly large reduction in longevity. And again, I think this really highlights, from a client perspective, what the consequences of taking risk are, because equity markets at the moment, in my view, have a fairly significant amount of risk, and that's okay if you're getting rewarded for that in the sense of significantly increased longevity. But certainly the decision making we've been running through with clients recently is when we do these numbers, a significant reduction in portfolio risk isn't necessarily correlating to a significant reduction in longevity, and that would sort of indicate there is some room to take some risk out of the portfolio. So this is just two examples of how we can use this dashboard to help our clients make some smart decisions with their money, but particularly using these 10-year forecasts that are updated every month and from external research sources, converting it to 80% confidence and converting discussions around risk and return into how long is the portfolio going to last certainly enables CSP clients to make some pretty smart decisions. Thank you for watching our introduction to CSP's Three Buckets program and the high-level overview of our dashboard. If our approach to investing has resonated with you and you'd like some more information, please feel free to jump onto our website at www.csp.com.au, and there you'll find our contact details where you can get in touch with us and set up an initial appointment. We look forward to talking to you soon. Thank you.